Let's start this episode by just reviewing what inflation is and how we measure it and why we care about it. And in general, inflation has to do with the value of the US dollar. And, we in our working years, in our careers, we earn US dollars unless you're like a professional athlete and have compelled your organization to start paying you in Bitcoin, like some NFL players are doing, as I understand it. But most of us get paid in dollars. And so, we go to work to earn money to feed ourselves and our families and to put money into savings so that we can stop working at some time before we keel over and die. And so we're transacting in fiat currency, which is basically paper US dollars. In other words, that's not backed by gold or anything else. And so inflation is when the prices of the goods that we buy with those dollars go up. And if you think about it, the other side of that, the other way of expressing inflation is when the value of those dollars go down. And if you think about your economics 101, supply and demand, you have supply and demand curves kind of go like this. For those of you who are listening and not watching, I look like a fool in the video here. I have my arms up in an X. But the idea is money when money is easy and when people have a lot of money, but the number of goods and services in the economy hasn't changed, the price at which those goods and services are exchanged, the market price, tends to go up because the same number of people are chasing the same number of goods. They just have more dollars in their pockets to pay for them. And in a competitive market, when the money supply goes up, prices tend to go up as well to meet that equilibrium point. And as investors, it makes sense to review how this impacts different asset classes. So again, I don't think that it makes sense to make adjustments to an investment portfolio because we saw a higher inflation number this last month than we've seen in a while. If you're someone who wants to structure a portfolio around this concept of potentially mitigating inflationary pressures, that's possible. But at the same time, it could be transitory, as the Fed chairman says. It could persist. We don't know. The path to the best outcome, and I'm probably sound like a broken record here, is a long-term, consistently executed strategy throughout all environments. And that is not going to change based on a number that comes out one week and causes a couple days of sell-offs. So let's review how inflation tends to impact portfolios. And what I'll do here is go asset class by asset class and just kind of share some thoughts. And the first one that we'll start with is equities, because that's probably the asset class that you have the largest portion of your portfolio in. For most people, we have a lot of clients with more bonds than they do stocks because they're more conservative, and that's totally okay too. But we'll start with stocks nonetheless. So stocks actually hold up really pretty well in most environments that are seeing inflationary pressures. And the reason is that if prices of the stuff you and I are buying and businesses are buying go up, a stock is just a portion of ownership of a publicly traded company. And if you think of the income statement of a corporation, they have revenues that come in at the top, and then they have the cost of their goods underneath that, and then they have other operating costs, debt service, taxes, and then they have profits that are left over after all those costs at the bottom of the income statement. And so if the cost of the goods that they're buying go up because of inflation, and if labor costs go up and other costs go up, it reduces profitability.